Right now, $41 trillion is circulating in a financial parallel universe. It doesn't sit in traditional bank accounts. It isn't tracked by the Federal Reserve's standard consumer metrics, and it operates almost entirely outside the strict regulatory safety nets established after the 2008 financial crisis. This is the global shadow banking system, specifically the explosive world of private credit. For the past decade, it has been the ultimate playground for elite institutional capital. Unregulated, highly leveraged, and intentionally opaque. But as we cross midway into 2026, the systemic danger of this shadow economy has fundamentally shifted. The risk is no longer just the massive accumulation of debt. The risk is who, or rather, what, is now controlling it. Without public debate, Wall Street has begun transferring transactional authority over these trillions to autonomous, agentic artificial intelligence. This isn't software that helps humans make decisions. This is software that has been given the legal right to execute trades, pull liquidity, and trigger liquidations entirely on its own. And the mathematical reality of an automated financial system is that it moves at a speed human regulators are physically incapable of stopping. To understand why this is a ticking time bomb, we first have to understand how the shadow banking system became so powerful. After the global financial collapse in 2008, governments worldwide panicked. They slapped massive regulations like Dodd-Frank and the Basel Accords onto commercial banks. They told traditional lenders that they could no longer give out high-risk loans to mid-sized corporations or highly leveraged businesses. The regulations worked. Traditional banks stopped taking wild risks. But the underlying demand for capital never went away. Businesses still needed massive loans to expand, restructure, and survive. Seeing a massive profit opportunity, private equity firms, hedge funds, and sovereign wealth funds stepped into the vacuum. Because they aren't depository banks, meaning they don't hold everyday citizens' savings, the strict regulatory laws didn't apply to them. They began lending out hundreds of billions, then trillions, in private, unlisted transactions. Today, this private credit ecosystem has ballooned into a $41 trillion pillar of global finance. It funds everything from massive corporate buyouts to infrastructural real estate. It is highly efficient, highly lucrative, and completely hidden from public view. But because it lacks the regulatory circuit breakers of traditional banking, it relies on one single, fragile pillar, which is perfect, uninterrupted liquidity. For years, the sheer opacity of private credit was managed by rooms full of human analysts, lawyers, and risk managers. They analyzed risk profiles, monitored corporate balance sheets, and manually adjusted loan terms. But according to the latest macroeconomic data, 2026 marked a permanent structural shift. Wall Street institutions, desperate to cut overhead costs and optimize yields, began deploying Agentic AI. There is a massive technical difference between the generative AI you use to write emails and the Agentic AI deployed on Wall Street. Generative AI is an assistant, Agentic AI an actor. These are autonomous software agents designed to operate independently within a network. They don't generate text, they settle complex trades, manage compliance portfolios, rebalance asset allocations, and dynamically adjust risk tolerances in real time without needing a human to click approve. If you're starting to realize that the mainstream financial media is completely missing this structural transformation, hit the subscribe button right now. On this channel, we look past the daily stock market noise and dissect the actual structural math of the global economy. So, what happens when a system built on $41 trillion of unregulated leverage is handed over to autonomous software code? You get the blueprint for a systemic Black Swan event. In a traditional financial panic, humans hesitate. When a market drops, an institutional risk manager picks up the phone. They negotiate, they evaluate market sentiment. They sleep on a decision to avoid triggering an outright collapse. Autonomous AI agents are incapable of hesitation. They are programmed with strict mathematical parameters to protect their specific fund's capital at all costs if a sudden economic shock occurs. Say, an unexpected spike in energy costs or a localized credit default. An AI agent at fund will instantly detect the breach in its risk parameters. Within microseconds, it will automatically execute a massive, multi-billion-dollar liquidation to preserve capital. But that massive liquidation instantly drops the asset value across the entire interconnected network. The AI agents at Fund B, Fund C, and Fund D will instantly detect that drop. Their code forces them to respond defensively. They simultaneously trigger their own automated liquidations to hedge their downside. This creates an instantaneous mathematical feedback loop, an algorithmic bank run moving at the speed of light. Because these private credit assets are unlisted, there are no public stock exchange circuit breakers to pause trading. By the time human regulators or fund managers even receive the automated alert on their phones, tens of billions of dollars in liquidity could vanish from the system entirely. When the shadow banking system faces an algorithmic liquidity crunch, there is only one entity large enough to bail it out: the U.S. Federal Reserve. But the Fed's ability to print trillions of dollars to stabilize global markets relies entirely on one assumption: that the rest of the world maintains absolute and wavering trust in the value of the US dollar. And as the global landscape fractures, that trust is being tested like never before. The internet will tell you the dollar is collapsing because of alternative currencies or oil trade changes, but the real macroeconomic math behind what actually backs the dollar is something completely different. I broke down the exact structural reality of the petrodollar myth in this video right here. Click it, look at the numbers for yourself, and I'll see you there.